Greetings from Kotak Mutual Fund. In the Indian equity markets, we see Triveni Sangam of flows, sentiment, and fundamentals. Domestic buying led by mutual funds is consistently positive and above average in a falling or a cheaper market. While FPI sold in September, their portfolio allocations are almost equal to the MSCI index weight of India. At lower levels, they are more likely to be a buyer than sellers. Retail and high net worth individuals are also looking to add on every correction. The sellers in the market is largely led by private equity venture capital funds and promoters. IPO supply is building up. Overall, flows will remain positive on every correction. Sentiments have turned favorable to India as it remains one of the fastest growing major economies in the world. Nifty EPS will likely touch anywhere between rupees 1100 to 1150 for FY25. Corporate profit to GDP is about 4% of GDP. Corporate profit to GDP ratio is about 4%. Corporate leverage is decadal low. Capacity utilization is upwards of 76%. India Inc.'s fundamentals across large, mid and small cap segment are pretty impressive. This Triveni Sangam of flows, sentiments and fundamentals have pushed markets to all-time high level with just a little above average valuations. Some dark clouds are gathering on the horizon. Oil is likely to cross triple digits due to cartelization by OPEC and non-OPEC countries. India, being the largest importer of oil, will have to pay some price. Uneven distribution of monsoon could impact Kharif crop. Water reservoir level are below 10-year average, mainly in southern India. This could potentially affect the Rabi crop. Agriculture and rural recovery are tied to each other and both can remain subdued in Kharif and Rabi season. The US Fed, having regained its credibility, is likely to keep rates higher for longer. They have kept room open for one more rate hike. It looks like that Fed's higher for longer could push US into recession, impacting global growth. Monsoon, oil, US rates, agriculture and rural recovery could play spoilsport in the near term. The elephant in the room is election 24 outcome. Today, market is discounting Modi's Sarkar. If a result is against the expectation of the market, then there will be, to that extent, upheaval. Undoubtedly, the India growth story remains one of the most attractive investment opportunities. As long as India delivers on the 3G of growth, governance, and green, long-term investors will reap the rewards. Our earnings growth has to be better than our peers like in the past. On a one-year basis, India may look expensive to peers, but on a 5-year basis, India should remain cheaper to its peers. Our corporate governance standard should remain superior to our peers like it is today in the days to come. And our growth should be green. India should achieve COP26 commitments and remain the lowest per capita carbon emitter globally. What should you do in the market which is likely to witness some volatility? One, remove all the leverage. This is not the market to run leverage positions. If you are a trader, then please follow strict stop loss policy. Don't keep an open position. If you are an investor, this is time to have equal allocation to equity as an asset class. If you are overweight equity, especially micro cap, mini cap, small cap, then please take some profit out. Keep some cash in the portfolio to take advantage of volatility, which may come due to any event from US Fed to oil to election 24. This is the best time to do portfolio cleanup. In today's market, Gadhe and Ghode both are running together. Get out of all kachra stocks from your portfolio, as in the bull market, all your mistakes can be wiped out. Please ensure that you don't commit new mistakes. Please continue with your SIP to participate in long-term growth story of India. As an investor, please take long-term view as India firmly moves from being 10th largest economy in 2014 to 3rd largest economy by 2030. I wish all of you a very delightful investing experience. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.